Good morning. It's the 12th of August and this is Govindraj Ethiraj, headquartered and broadcasting and streaming from Mumbai, India's financial capital. The Take. Many years ago, I remember interviewing the late Yogi Deveshwar, who left cigarette and consumer products giant ITC to join Air India, then a government company, as a lateral hire, and he was chairman between 91 and 94. That's 1991 and 1994. He thus became a government employee but could not last long and then finally went back for a solid stint at ITC until 2017. I asked him at a later point why he returned to ITC because the perception at that point was that Air India was a much bigger mandate and challenge. He said that it was too much and he felt that he had a great opportunity at ITC. Unsaid was the fact that he was tired of battling the entire governmental system which was so firmly entrenched in running Air India those days. Let me switch gears, actually again a little bit. Gary Gensler is the chair of the US Securities and Exchange Commission, the powerful body that regulates all aspects of the United States securities industry, including, of course, stock markets. Now, Gensler was a professor at MIT Sloan before he came to the SEC, and earlier in life, before joining public service, he worked at Goldman Sachs and even led fixed income and currency trading in Asia. And there have been other senior Treasury Secretary officials, the equivalent of our finance minister, to emerge from Goldman Sachs. Steve Mnuchin, who became Treasury Secretary in the Trump administration, was the third Treasury Secretary to actually come from just Goldman Sachs. Robert Rubin in 95 to 99, and Hank Paulson, who headed the Treasury Department through the 2008 financial crisis. Now, even at that time, while there were some noises about Hank Paulson trying to save his friends on Wall Street, they died down pretty fast. So why are we talking about SEC and other private sector appointees when the news is about SEBI? I'm coming to that. It's taken time for Indian financial markets and specifically SEBI and Securities Exchange Board of India, that is, and the Reserve Bank of India to bring in lateral hires. The Reserve Bank of India brought in Raghuram Rajan, who spent time as professor at the Chicago School of Business, as the chief economist for the IMF, and then he became governor. And SEBI brought in Madhabi Puri Buch, who spent considerable time of her professional life in ICICI Bank as part of the original growth team. Now, whatever the outcome of the latest salvo that Hindenburg Research has fired at SEBI, its chairperson and the Adani Group at the same time, it should not be that lateral hires are discouraged, nor should lateral hires feel discouraged. For lateral hires from the private sector, unfortunately, it also means that scrutiny is much higher, also because India is still adjusting to this way of life. So the US system that I referred to in the case of the SEC or the Treasury Secretary is more accustomed to people moving from private sector to government and then back to. This also means that the systems to manage these transitions, including the disclosures, are rock solid so as to ensure there is no suspicion that someone is batting for their old friends. So the question to ask now is India there? And answering this question and addressing it for future hires is critical. And more importantly, what can we do to improve the transparency and disclosure levels? Now, on Hindenburg's latest salvo, there is nothing in it that suggests, having looked at the allegations and the rebuttals from the SEBI chairperson, SEBI, and other funds in which they invested overseas at various times, and of course the Adani Group themselves, that there was any material benefit to Ms. Buch. Now, this is all based on the information that is available at this point. SEBI even put out a statement saying that it has noted that relevant disclosures required in terms of holdings of securities and their transfers have been made by the chairperson from time to time. The chairperson has also recused herself in matters involving potential conflicts of interest. Now, this is all internal. Now, let me recap quickly. In the latest report released Saturday night, Hindenburg projected links between offshore funds that traded in Adani Group shares with personal investments of Buch and her husband. It says one fund, the Bermuda-based Global Opportunities Fund, was used by entities connected to the Adani Group to trade in the shares of group companies, and that had sub-funds. Now, she and her husband were investors in one of these sub-funds in 2015, according to Hindenburg, and this it bases on whistleblower documents. Incidentally, the fact that a whistleblower, quite likely sitting inside SEBI, delivered the documents to Hindenburg is intriguing and interesting at the same time. Anyway, in 2017, before Buch was appointed as a full-time SEBI member, her husband requested to be the sole operator of the account, and in 2018, she wrote an email seeking to redeem her husband's entire investment in the fund. Now, all this is from whistleblower documents and can also get a little complex in detail. However, in 2022, Buch was appointed head of or chairperson of SEBI. So Hindenburg closes off by saying that their findings raise questions that merit further investigation and they welcome additional transparency, and they seem to have left it at that. Now, Buch's position expectedly is that they had no hesitation in disclosing any financial documents to any authority, and all disclosures as required have already been furnished to SEBI over the years. And the sub-fund that she had invested in released a statement on Sunday saying it had not invested in any shares of Adani Group. Now, we're going to dive into the disclosure part shortly with Ajay Rotti, but it would appear that there is a case to be made for greater disclosures in future, particularly in sensitive public positions like a SEBI chief. So the argument, let me underline, is more about the spirit of disclosures rather than the letter of disclosures, which may have been met. Now, for someone coming in from the private sector, some of it might seem excessive and even painful, but this is the price to pay for public office. And no amount of disclosure is less. It's also amusing in a way to see how all the players named have circled their wagons around the SEBI chairperson, including or separately the Association of Mutual Funds of India. Now, why an industry body would shoot off letters of support beats me. There is no need. The way forward is tricky. Ms. Buch, the chairperson, would do well to distance herself from a formal probe to establish the facts and present them. She would do even better to set new guidelines for transparency and disclosures and set an example by uploading all her assets and transactions, including the family, on the SEBI website. She should do it quickly too. But the wrong thing to do would be to take cover behind character certificates doled out on social media or by institutions like the Amphi or shoot the messenger. Hindenburg actually does not matter here. And our top stories and themes. The markets are set to hold steady once again after a rocking Friday. Global anti-money laundering watchdog wants India to step up diligence on politicians. Should SEBI set higher standards of disclosures on key staff? Computing India's inflation numbers. What's working and not?
This is the Core Report with Govindraj Ethiraj.
Will the markets pick up from Friday? The BSE Sensex and NSE Nifty ended last week's trading session with gains, closing higher by almost 1% each. On Friday, the Sensex climbed 819 points to close at 79,705, and the Nifty 50 ended 250 points up at 24,367. The broader indices like the Nifty Next 50 and the Nifty 100 were all positive, as were the mid-cap and small-cap indices. Elsewhere, Bloomberg reported, this is global news, that hedge funds are the most bearish on commodities prices in at least 13 years as fears of a deeper economic slowdown cast doubts on demand for everything from crude oil to metals and grains. Speaking of crude oil, it's higher now compared to what it was last week or earlier last week and is now just under $80 a barrel. So the big question, of course, is will Hindenburg's latest attack affect the markets? Well, it does not look like, as there are no stock-linked revelations. And of course, that's so far. And everyone seems to have banded together to issue very strong rebuttals and clearly has been working hard all of Saturday night and into Sunday. The Financial Action Task Force, or FATF, Global Anti-Money Laundering Watchdog, has asked India to improve due diligence on the bank accounts of local politicians, government officials, and their families, according to Reuters. The recommendation for tougher checks on the finances of politically exposed persons, or PEPs, is part of a FATF review of India's anti-money laundering systems that began in 2023, and a report is expected soon. Under global rules, politicians, their families, and close associates are subject to checks on their bank accounts due to their potential susceptibility to bribery and corruption. The FATF report, shared with the government of India, that is, recommended more rigorous monitoring of the sources of funds of the accounts of domestic PEPs, that's politically exposed persons, as well as requiring senior bank managers to approve any new accounts for them or their families. You may or may not have noticed that KYC forms ask you to now reveal that factor, which is that if you are close to a politically exposed person. A finance ministry official told Reuters that there were areas that we needed to improve and which we would. Interestingly, last December, the government told Parliament it did not intend to put domestic political figures under stricter banking scrutiny, adding that it would wait for the FATF's report before making any changes. The FATF rated India as a compliant and largely compliant on 37 out of the 40 parameters for enforcing anti-money laundering laws, according to that Reuters report. SEBI chairperson Madhabi Puri said on Sunday that all their investments and business activities, including shareholdings and company statuses, have been transparently reported to the Securities and Exchange Board of India, Singapore authorities, and Indian tax authorities. Now, that's quite likely true. The larger question is it enough? And what are the lessons for the future for officials holding public office in securities markets in specific and government in general? I spoke with Ajay Rotti, founder and CEO of Tax Compass based out of Bangalore, and I began by asking him what were the level of disclosures, ideal or otherwise, and lessons from the current episode.
From a actual disclosure perspective, until the report came out last evening, I don't think we knew any of this ourselves. So in that sense, there was no voluntary disclosure from the chairperson's side or anybody in SEBI in relation to this. But now, after having seen the facts, the dates, if we are able to link the dates when they exited, what has happened, and also the disclosure by IIFL that there have been no investments, maybe in their wisdom they thought it's not important enough to disclose, etc. But even if they had to disclose, the code of conflict of interest that applies to all members of SEBI board, including the chairperson, only requires them to disclose those investments and interest to SEBI. So which they claim to have done. Therefore, the fact that they had investments or they have investment in some of these consulting companies in Singapore that has come out in the report, the chairperson says that they had disclosed this to SEBI at the time of appointment, and in any case, the other investments were exited before she actually got appointed.
And let's look at the code on conflict of interest for members of the board, which was released in 2008, which is interesting because I don't know if there was an earlier version. I mean, SEBI came up in 93. So till 2008, if there was no other code before that, it looks like the code only came up then.
Yes, it is interesting that we've got it in 2008.
I guess these things happen when you face situations like this, and then, which will also bring me to my other question in a moment. But if you look at the code itself, there are a couple of areas: conflict in respect of agenda, which means if there is any perceived conflict in even somewhere because of some company where you may have common shareholding or co-invested with someone, you should have declared it to the board. So one should assume, therefore, that all this has been declared to the board, right?
Yeah, that should be the assumption, because you're right. There are two parts to it. One is on conflicts relating to what comes up before the agenda. And second is more on investments. And investments requires ongoing compliance and disclosure at the end of 15 days from the end of the financial year, they're required to disclose. I guess some of these should have been disclosed if there was indeed a conflict and there was indeed an investment in related entities, etc.
Under the term other disclosures in the same code on conflict, it says members should disclose any post-employment or fiduciary position which a member holds or has held in the past 5 years. It also talks about disclosing significant relationship, including professional, personal, financial, held in connection with a regulated entity. And even an honorary position should be disclosed. So do you feel that this is enough as things stand before we look ahead?
In my view, some of these disclosures, and especially any professional other relationship that especially close family members have with organizations which are regulated, listed, etc. While disclosure to SEBI is what the code of conduct requires, I would think the more appropriate one, after going through and seeing what we've seen here, maybe to do a public disclosure. Today, we've had situations where even the High Court judges today are required to put up their asset list on the website. Of course, some have not yet complied, but then that's really what has to be done as the courts have taken the view. Plus, if you see our MPs today, their affidavit has disclosure of every assets that they own, including investments that they have done and things like that. So maybe even for the full-time members of SEBI, of course, there's some carve-outs for government-appointed nominees, etc. You could look at some carve-outs like that. But for especially important positions like chairman, chairperson, etc., who can decide courses of investigation, choice of entity, etc., maybe a public disclosure may be a better thing going forward. To actually put up on the SEBI website that this is where the interests are, these are the investments, and these are the associations that the spouse, family, children have with some of the regulated entities.
Right. If you were to now contrast this with the overall levels of disclosure in public office, any thoughts there?
That is something where we've been improving as a jurisdiction, as a country over the last few years. We were terrible even on disclosures of MPs and our elected representatives many years back. So there is always a scope for improvement when it comes to disclosure. The more transparent, the better it is. More particularly when today we are looking at people coming in as lateral hires. And so if you see all the list of SEBI chairmen in the past, incidentally, Ms. Buch is the first lady to have held this office and is also the first non-bureaucrat or non-government undertaking. So all others were IAS or from IDBI and organizations like that. But never has a private sector person got into a role like this. So with that happening more, the disclosure and transparency has only got to go up, because private citizens will have had their own transactions before they've come in. Unlike bureaucrats who would have followed some of these mode of code of conduct, disclosure, not investing in certain companies, etc., all their careers. But if private people are coming in, the disclosure standard has definitely got to go up even further.
And if you were to look at, let's say, company boards and
Right.
how as a country we are now in terms of disclosures and transparency, how would you contrast that with, let's say, the disclosures and transparency levels in a board of a SEBI, or it could be a Reserve Bank or similar organization?
I think there should be higher standards for regulators, for the examples that you took, RBI, SEBI, etc., than compared even to the board, company boards. Company boards, independent directors may have to disclose, and they do disclose if there is conflict of interest, and they don't participate in some of the agenda items, voting, etc. But I think, in my view, people holding public offices, regulators, definitely need to have a lot more higher standard in disclosure and transparency.
If this was a company board or similar, how would you think that this should play out now? How do you feel it should be handled?
I'll reserve my comments in terms of all the facts coming out, because they're still coming out.
Absolutely.
Yeah, the dates are important, when they've actually invested, not invested. I don't know if whether they've made gains or not will be that important, while it may eventually play out a role. But I think when we are looking at disclosure, it has to be more on whether there was indeed a potential possible conflict rather than if it resulted in a pecuniary gain, etc. So I think we'll have to just wait and see in terms of, what disclosures were actually made. Was SEBI kept informed? If SEBI, who in SEBI? Because remember, we are talking of the chairperson. The other whole-time members of the board could have said, we've disclosed it to the chairperson. And the chairperson, if they say that we've disclosed it to SEBI, who in SEBI would have been actually privy to this information and what was done about it. So a few more facts have to come out. I think they will get to the bottom of this. And that's, I think, the need of that. Rather than, look at what this means and if it's actually a fraud, scam, etc. I think we should be focusing on getting more information, and actually SEBI and the chairperson have to disclose a lot more in terms of what has come out at this point.
Right, Ajay. Thank you so much for joining me.
Thank you, Govind.
India could rejig how it calculates inflation. Is that a good thing? An Indian government panel tasked with revising the nation's consumer price index is considering a substantial cut in the weightage of food, according to Bloomberg. The panel that's part of the Statistics Ministry is discussing a proposal to reduce the weight of food in the consumer price basket by as much as 8 percentage points, according to someone who did not want to be identified. The food and beverage category makes up about 54% of the current consumer price inflation basket, which in turn is based on consumer spending patterns surveyed in 2011-12. So that's 12 years ago, which economists, not surprisingly, say are outdated and may be distorting the official inflation data the central bank uses to set interest rates. So now you can see the data, or the importance of data and the integrity of data, and the links between various types of data and policy actions. For example, recent surveys show that consumers are spending less of their budget on food than they did a decade ago. So the Reserve Bank of India right now has kept interest rates unchanged, obviously for more than a year, including last week. The CPI, or the Consumer Price Inflation Basket, has about 299 items, of which many are outdated, like horse cart fares and video cassette recorders, and costs of audio and video cassettes. And all of this obviously need to go. So the changes to the CPI weights and the base year, which are under consideration, however, could only be implemented by Jan 2026. India's chief economic advisor, V. Ananta Nageshwaran, last month argued that the central bank's inflation target should exclude food. So to get a sense on what is at play here and the larger objective, and whether that will affect what we see and believe of inflation data, I reached out to veteran economic journalist Shankkar Aiyar, and I began by asking him if the current index was representative of what was happening in the economy.
I think the current index is not completely representative, because it sort of ignores the new pattern of expenditure of people in education, in health, in travel. So it doesn't sort of focus on the rise in prices or costs of people when they address issues at home. For instance, rent. For instance, owner equivalent rent, whether it's placed there. The other thing is that consumption patterns at home of what we have on our thali have also changed, and it may not necessarily reflect the costs that are. So, as you know, that CRISIL puts out this vegetarian and non-vegetarian thali prices, and there's quite a bit of divergence in that. So, I think these factors need to be taken into account when they reconstitute the CPI. I mean, the golden rule here is that what you measure well can be improved.
Got it. So if you were to now look at, let's say, food. Now, food inflation is very high. Now, one of the proposals is that we remove food from that computation I mean, which may be a little dramatic, but let's say the food component comes down. Does that, in your mind or assessment, change things? And to what extent, if it does?
So roughly for about 10 years now, it has been argued that in the consumption basket of the average Indian, the weightage of food, the amount of money that they spend on food has come down from maybe over 55% to under 50% or 45%. Now, the thing here is that how consistent is that data? How geographically uniform is that data? This might have spikes. Now, for person staying, say, in an urban metro like Mumbai, may be spending less, but they are spending on services to get that food home delivered, or services like Amazon to get that delivered. How do we factor that in? So these are sort of complex interlinkages that have to be sort of. So we might be well placed now to reconfigure the CPI in terms of what is the actual spending on what product, and then update the services part of it so it reflects the real consumption of people, and therefore we get a better idea of inflation.
So, if you were to now take a step back, and I guess this is more intuition, or this is also intuition, are CPI numbers or inflation numbers reflecting what the majority of this country is feeling at this point of time or experiencing?
But the question is contextual. If I go to the bazaar today and buy vegetables and fruits, I do feel that inflation is very high. But if I shop on discount retailers, maybe I don't feel that so much. So a lot of it depends on the experiential. What is important is the farm gate prices and the market prices. There's a wide divergence. I mean, in most perishables, that is the case. I mean, you can't buy any fruit in India less than a 3-digit cost. So, I mean, that's kind of sad considering that India is the largest producer of fruits and vegetables in the world. So, question that we are wrestling with is whether the CPI, as we see the industrial worker, the agriculture worker, and others, needs to be reframed into CPI for metro, CPI for income classes, or CPI for social groups. Maybe that's the way to sort of frame this issue of whether it reflects. I don't think the current CPI is adequately representative of the costs faced by Indians, whether in cities or in villages.
Right. So, all of this is going to come together or happen only by Jan 2026, from what it appears or what has been reported. Is this something that, let's say, the policy maker ecosystem can wait for? And till then, how are we taking our decisions or even calibrating our, let's say, interest rate responses?
I mean, the world over, this is a question that central bankers are wrestling with, is that they are expected to address that which they cannot address. Whereas basically, inflation targeting has its own limitations, just like there is a limit to how much you can push a thread. Here, what is expected is that central banks should bring down through their monetary policy measures costs of products, goods, food that are supply constrained. For instance, the Reserve Bank of India can do very little to bring down the prices of vegetables and food grains, in a sense. What it also sort of reflects is that the current CPI does not reflect the free food program. I don't know how they factor that in the CPI calculation. Now, if the RBI is expected to bring down the prices of crude oil if they go up in the global markets, it's very difficult. And no central bank can address issues that are supply constrained. They can only address the demand part of the equation, which is why it is a very blunt instrument. So what policymakers are sort of toying around is to see whether that which is supply constrained can be kept out of the basket.
So, Shankkar, let me come back to the comment from the chief economic advisor last month, which said that the central bank's inflation target should exclude food. And what's your sense?
I find it a little problematic, this suggestion that targeting should exclude food, because food prices and fuel prices have a tendency to seep into wages. Now, unless they can prove it to the contrary that this is not happening, and wages sort of creep into the core inflation. So if you see the alignment, once food prices go up, workers want higher prices. The DNS allowance of governments is adjusted to costs. And in a similar way, it sort of seeps into the wages. Wages impact core inflation. So I find it's problematic that maybe there is an argument to be made that central banks are unable to address issues that are supply constrained, for instance, food prices or petrol prices or gas prices. So maybe there is a problem. But this is easier to address if we look at if the Reserve Bank, for instance, formulates its interest rate policy looking at the core inflation. Why do you have to sort of declare anything or announce anything on whether this should be in the targeting or not in the targeting? I mean, if the composite picture that the RBI has includes all the factors of the financial markets and the real economy, and it should take a call. I think this requires some more study. I think my trouble is, my worry is that sometimes in India, in trying to solve one issue, we create other problems. So I hope that is not the case here.
Shankkar, thank you so much for joining me.
Thank you, Govind.
And before I go, here's some feedback from all of you. Saravanan Thambuswamy says he likes the market status and industry perspectives and would like more global news as well as to see some focus on startups. Okay, Saravanan, we'll try and bring that in or more of that for sure. Deepak R. Bhojwani says, given the current trends of public sector units driving investments, he would like to see weekend editions to focus on different sectors that PSUs operate, and each weekend could have a detailed analysis on one subsector analysis of a public sector unit. So if we take banking, we could look at State Bank of India and other nationalized banks and potential trends. If it's railways, we could look at RITES and IRCTC. Absolutely, Deepak, point taken. And we will try and bring definitely more on rail, which I've been trying to, but not somehow had much luck so far. But I'm sure we can. All of this, Deepak says, would be informative for listeners and they can make an informed opinion. He would also like to see some coverage on biotechnology, artificial intelligence, and trends in India. Artificial intelligence is something that we're already doing in a collaboration with NASSCOM, the industry body. So do watch out for that as well. Thanks so much. That was the Core Report with me, Govindraj Ethiraj. Do stay connected with more of our coverage at the Core. You can check out our website or sign up to our newsletter for our exclusive stories, one in-depth feature a day on www.thecore.in. Do also track us on LinkedIn, where we usually post synopses or extracts of our top stories and interviews. We would love your feedback on how we can make business more interesting and relevant, including, of course, India's vibrant manufacturing sector. So write to us at feedback@thecore.in. And thank you once again for listening.